The PIMCO Dynamic Income Fund, or otherwise known as PDI, is a very popular closed-end fund, or CEF, with many retirees. And one of the big reasons for this is because its dividend yield is about 13.9%, which is obviously very attractive, and it pays out its dividends monthly. So you're getting more than 1% on your principal every month from PDI. So obviously that is very appealing to retirees who are often living off of their income, or really any investor, because you could think, okay, if they can just sustain their net asset value over time, I'm going to get that 13-14% dividend yield. That's a pretty awesome total return just there without needing to generate any kind of growth. That being said, there are significant issues with PDI, and for that reason, I'm rating it a sell right now. In this video, I'll dig into why that is. Hey everyone, this is Samuel Smith. I run High Yield Investor, the top-ranked investing group on Seeking Alpha, and I specialize in dividend investing. I recently launched this YouTube channel in order to share my unique approach and lessons I've learned the hard way about dividend investing with a broader audience. So if you could please like this video, subscribe to my channel, and share with me in the comment section below what you liked about this video and what your thoughts are in PDI, I'd be greatly appreciative. Thank you very much. So why am I not confident in PDI? Well, the biggest reason I don't like it right now is simply the fact that it is heavily leveraged. It has nearly 40% leverage on its balance sheet of these loans that it's investing in. That sets it up for a dramatic drawdown if these loans were to suffer. And there's history to show that that has happened in the past. In fact, as recently as 2020, it was in a similar situation where it's heavily leveraged. The economy crashed due to COVID-19 and the lockdowns that followed, and PDI's net asset value plummeted. And it plummeted much faster than the broader sector that it belongs to, precisely because of this heavy leverage. And another reason why this leverage is so bad is because of the quality of the loans it invests in. Only about 10% of its loan portfolio is investment grade. The rest is junk bond. In fact, a very large segment of those are not even rated or rated B, which is very, very low into junk territory. And so as a result, these are much riskier loans, so that if and when the next downturn hits, there's likely going to be a surge in non-accruals or even defaults on these loans, which will hurt PDI just from that, but the leverage will magnify it significantly more. And so if that were to happen in a sustained manner, PDI would very likely have to slash its dividend quite significantly. Another reason I don't like PDI is because the economy right now does indicate that this very scenario may play out. For one, unemployment has been rising steadily over the past year and is now at about 4%. Consumer confidence is waning. Consumer spending is weakening. Debt has surged across the consumer and corporate levels. And even Ares Capital Corporation CEO, a company that invests in these low-rated bond-type investments that are somewhat similar to what PDI invests in, their CEO even warned that this year they expect defaults to spike across the industry. And so that's very negative for PDI. Howard Marks, the legendary credit investor at Oaktree Capital, he and his team have also said that they think that the loans in this category are some of the lowest quality that they've been in a long time. And so for that reason, I'm very concerned about PDI. Two other big reasons why I don't like PDI right now is one, that it trades at a very steep premium to net asset value, a premium of over 13%, which is not only high on an absolute basis, especially given these other dynamics in the industry and the fund that I've mentioned, but also compared to its own history. Historically, it's averaged only a single digits premium to net asset value because PIMCO is a pretty good manager, and so it does perhaps deserve some premium to its net asset value, but not like that. And so with a 13 plus premium to NAV, there's significant downside just from it going back towards more historical norms. So if you combine that with the heavy leverage in the fund, with the weakened state of its underlying holdings, with the weakening state of the economy, there's potential for a massive downside in the fund. And the final reason that I don't like PDI right now is simply the fact that it's very expensive. It charges a near 2% expense ratio for what it does. And that's not even counting the expense that it pays on the massive amounts of leverage that it has for the interest for that debt. So when you combine all that, I just don't see how owning PDI, despite its near 14% dividend yield, makes any sense right now. I think high yield investors are setting themselves up for a mega crash and mega downside in this fund. If you enjoyed this video, or maybe you didn't enjoy it if you're invested in PDI, but if you found it interesting and useful for you in your investment journey, I'd please ask you to like this video, subscribe to my channel for more content like this, and share with me in the comment section below what you benefited from the video. Maybe you disagreed with it and why. Share with me that. Any of that would help me to grow this channel, and I'd be greatly appreciative. Thank you very much, and see you next time.